Okay. Should we start?
Let's start.
All right. It's May 19th, 2021, and I'd like to call to order the meeting of the Investment Advisory Commission. It's 4:32 p.m. We're going to skip the Pledge of Allegiance due to the absence of the flag. And Shannon, if you could take roll call, that would be great.
Yes. Chairperson Elizabeth Pagliarini.
Here.
Vice Chairperson Richard Steinhoff.
Here.
Commissioner Brant Cranmer is absent. Commissioner Arthur Levine.
Here.
And Commissioner Edward Rosenblatt.
Here.
Thank you.
Okay. Shannon, are there any public comments to be made today?
No, there are not.
You're not. Okay. I know we usually move on to the consent calendar, but if we have, I don't know, do we have guests from our Chandler today with us?
We do, but he is going to speak after the consent calendar.
He is? Okay. All right.
Yes.
Commissioners, do you have any questions on the consent calendar?
I don't.
No.
Okay. Can I get a motion to approve the consent calendar?
I motion to approve the calendar.
You have a second?
Second.
6. Is
Right.
that part of the consent calendar?
Item 6 is yes.
Okay, I just had a quick question, probably for my own edification. Under general operating revenue, that's a big chunk of money, and it does identify $225,000 from waste management, but there's a lot more. Can you give me another example of what else would be considered other revenue in that area?
I'm sorry, I missed your question. It might be something I might have to get back to you, if that's okay. Can you repeat your question, Arthur?
Sure. It's under general fund operating expenditures, where it says other revenue, and that's a big number, and it does mention the waste management contract of $225,000. I was just curious as to what else would represent a big piece of that revenue that's categorized as other. Pardon?
Okay. Let me look into that, and I'll email you with the answer.
Is anybody else having sound delay, or is it just me?
It could be because I'm calling in. There might be a little bit of a lag.
Do that another time.
Okay, so Andrea, you'll get back to Arthur on that question?
Yes.
Okay, great. And we had a second. Did we have a second on that motion? Can't remember.
Yes, I say.
Okay.
I second.
All right. Commissioners, can you verbally state your name followed by your vote on this motion?
Rich Steinhoff, yes.
Edward Rosenblatt, yes.
Art Levine, yes.
All right. Elizabeth Pagliarini, yes. Okay.
Brent, if you can hear us, since you're present now, you can approve the consent calendar if you'd like to be a part of the vote.
It doesn't look like Brent can hear us.
Okay, we'll put him absent for this part, and then I'll email him and see if he can hear us.
Okay, great. So that motion passes unanimously by the commissioners that are present. Do we have a staff report?
Yeah, so for the quarter end March 31st, 2021 investment performance review, we have Mia and Chris from Chandler Asset Management, who will present a report for you.
Great.
Mia, I think you're on mute.
My apologies. I was also having.
We still can't hear you.
Yeah, Mia, we're having a hard time hearing you. Can you guys hear me?
Yeah, I can hear you.
Yeah,
Okay, perfect. So again, it's good to see everyone. I know I'll kind of jump ahead. I know Mia's saying hi as well. Looks like we're still having some of those, challenges that we experienced in 2020, kind of with this virtual environment. But the good thing is, it looks like we're getting better towards that spot where pretty soon, hopefully, we'll be able to meet in person. As I know I've done in the past, what I'm going to do is just share my screen, if that is all right, for that report, and then go through some economic commentary and then a review of the city's portfolio. And I want to make sure, and can everyone see my screen?
yeah.
Yes.
Yep.
Yes.
Perfect. So as I mentioned, we'll go through a little bit of economic commentary and then go through the portfolio as of the end of March 31st. I took a look. We met back in February 17th. And back then, when we were talking about the economy, I focused on three things that were continuing to impact the economic progress in the U.S. And it was the path of the virus, it was the distribution of the vaccine, and again, it was the fiscal stimulus, the support we've seen from the federal government. And since then, what we have seen is immense progress and success on the rollout of the vaccine distribution, which has caused an upscale of the reopening, which has then also caused a change to the projections for economic growth in the U.S. for 2021. When we met back in February, we were talking about GDP somewhere in the range of 4%. Right now, because of the distribution of the vaccine, the reopening, the pent-up demand, the economic activity we're seeing right now, we're expected to see GDP in the United States come in around 6.3, 6.4% for 2021, which would be the highest GDP we've seen since 1984. So with that, combined with the reopening, with the massive amount of fiscal support we've seen from the federal government over the past year, that has accelerated the growth expectations for 2021. And what we've seen is the data coming in continues to show signs of improving and growing as we see the reopening of the economy with the reopenings regionally and with the vaccine distribution. However, we have seen some challenges with some of the data. Not meeting expectations, there has been some volatility, especially around some mixed data coming in from employment. And with that, the Fed has maintained their accommodative stance, not adjusting their federal funds rate and maintaining their asset purchases, which I'll talk about. But with that expectation for growth, what we saw in the first quarter was a significant increase in the yield curve. In a sense, the yield curve steepened significantly from the beginning of the year because of those growth expectations that we're seeing, as well as inflation expectations that I'll talk about in a second as well. Okay. Now, what we've seen from the support from the federal government has been massive. We put this together to kind of break down the American Rescue Plan, which was the phase 4 of the stimulus in response to the corona pandemic. And as you can see, totaling amount of $5.5 trillion. 42% of this going to individuals. The difference with the American Rescue Plan comparatively to previous plans is we actually saw money going to local governments, around $360 billion, as well as you can see the breakdown from the other areas that the bills provided support for. What is interesting with this massive bill is that we're starting to have conversations of the impact that is going to have on inflation. We're already starting to see some inflation metrics come in that are higher than expected, as well as the representative of the debt to GDP ratio that exists now. By the end of this year, we're expected to see the debt to GDP go over 100%, closer to 102%, which will be the highest we've seen since post-World War II. So there's some current concerns about that and the impact that that would have. But the Fed has maintained that they are still in their accommodative stance moving forward. Fed president, the Atlanta Fed president Bostic came out this week and said that they expect a lot of volatility in the economic data through the summer. and that they're actually looking for possibly a little bit of clarity when we'll start to get a little bit of normalcy in some of the data in September, when we go back, when all of a sudden we see schools reopening, as well as when we see some of the expiration of the unemployment benefits. So we've seen some challenges recently with labor not meeting expectations, and because of that, the Fed has maintained two things. One, that they're going to keep that federal funds rate at that zero bound rate, which you can see in the upper right-hand corner, given the expectation until 2023, as well as they are maintaining their asset purchases. The Fed has been purchasing $120 billion a month of treasuries and agency mortgage-backed securities onto their balance sheet. They have indicated that they are not even in the position yet to discuss about when they could possibly start tapering that or lowering those asset purchases on a monthly basis. When they do, they have given us some indication that it'll probably come from the agency mortgage-backed securities, that they'll start tapering them before they taper treasuries. But we're expected, we saw some minutes today from the Fed indicating that in the upcoming meetings, some members of the Fed believe that they should start to begin to have that discussion about the tapering. So it's something that we're kind of targeting around Jackson Hole in August, that we could see some information from the Fed regarding that possible asset, the purchasing, the tapering of their asset purchases. Why they've still maintained that is because of some of the mixed messages we've seen on the employment side. The Fed has two mandates: full employment, stable prices. What we saw, the April jobs report, significantly underwhelmed expectations, whereas the forecast was for 1 million jobs, and it only came in at 266,000. The unemployment rate ticked up to 6.1%, mostly due to the fact that the participation rate increased from 61.7% from 61.5%. But one of the challenges still we see is that the U6, the underemployment rate, is still fairly high at 10.4. And some of the labor challenges that we're actually seeing, workplace challenges, are kind of expecting to move forward. Fed Chair Bullard, he's the president of the St. Louis Fed, actually came out this week and said it's a better realistic expectation that to expect 500,000 jobs per month than 1 million jobs per month. So the jobs report is giving us mixed data, first off, because non-farm payrolls were not coming in as high as expected. However, we are continuing to see improvement numbers for the unemployment claims. Unemployment claims continue to trickle down. As of this report, it doesn't include those as of May 8th, where they actually came in at 473,000, which is the lowest we've seen since pre-pandemic. So in a sense, it's that trend we're seeing in the positive direction with regards to unemployment claims, mostly in connection with the reopening. Some of the positive numbers with new jobs and the sector that was impacted the hardest, leisure and hospitality, is definitely seeing some positive numbers with the reopening. Although I know me and I have been talking about this a lot. I'm sure you guys seen it. As we've seen this reopening with the vaccines going out, there's two signs I see at restaurants. Please be patient because they're understaffed. And two, we're hiring. And that's something that we're definitely expecting to see throughout the summer. And I have heard some challenges as well as individuals going on vacation in Hawaii to other places around the country right now, seeing areas understaffed, especially in hospitality and leisure moving forward. So there's not expected to be any clarity to that till once we get to September. And again, with the expiration of those unemployment benefits from the most recent support package from the federal government. Now, one of the other areas that has caused a lot of concern and has been in the headlines a lot has been inflation. So you can see here the numbers for March, where CPI came in at 2.6% year over year. What we're not showing here is the number for April. Prior to the creation of this report, April CPI came in at 4.2% year over year, which is the most since 2009. Core CPI, so in a sense removing energy and food prices, increased on a month-by-month basis at 0.9%. So it's the most that we've seen since 1982 for that increase. The data is definitely showing pricing pressures are running hotter than expected. But the challenge here is whether this is going to be temporary or this could actually be perpetual. And a lot of the conversation around being temporary is because of the impacts from it base effects. In a sense, what we're doing is we're comparing current prices to prices where they were at the beginning stage of the pandemic when everything was shut down a year ago. So We've seen increases in April. We're expecting to see high inflation numbers in May. And even the Fed has come out and said they are expecting to see the economy to run hot a little bit, but they are expecting it to be temporary. Now, the Fed is looking, they don't look at CPI, they look at PCE. PCE is a broader range of goods and allows for the replacement factor. And they focus on core PCE to be above 2% over an economic cycle. The Fed has also indicated that even though they are seeing inflation run hot right now, they do believe it's temporary. They do believe it's transitory. However, if it does not become transitory, they definitely do have weapons in their toolkit to be able to address it if it is sustainable more than they are expecting. So again, this comes back to the fact of looking at see how expectations for the economy, especially with inflation and employment, come through for the second half of the year, kind of after September, when we're starting to get back into more of that normalcy that we saw pre-pandemic. Any questions about those two before we move forward? Perfect. So a couple other areas, again, with the consumer, as we've seen this reopening, again, the impact from a inflationary expectation. Everyone's got a lot of money in their pocket, especially from some support from the federal government. With that pent-up demand, we saw massive amounts of retail sales numbers increase by 27.7% in March. A lot of those numbers, again, were in restaurants and bars. We saw a large increase there. We saw a large increase in sports apparel as well, which is another in sporting goods. So it's areas that, again, as we see this reopening with the vaccine distribution, we're seeing definitely improvement numbers in the consumer. And the consumer is important because 70% of our GDP comes from consumption. Now, one of the things to look at that we saw coming out of 2020 was the change in behavior of the consumer, moving more towards e-commerce. In a sense, that Amazon model, ordering things online. I think I talked about this last time. I'm shocked that my grandmother orders groceries online, but she continues to do so. And what we saw is e-commerce increased to represent a total of 14% total retail sales in the fourth quarter of 2020, and that's up 32% year over year. So it's interesting how that impact it's going to have on the economy moving forward. But as you can also see, consumer confidence continues to increase coming out of the regional shutdowns, the improvement of the vaccine distribution, as well as the fiscal support. Economic activity, again, we're seeing positive numbers here. They did see a little bit of glitch early in the year. I believe those are weather related. But again, the numbers, especially from the Chicago National Fed Index and leading economic indicators, are indicating that we're moving towards above trend growth in both of those positive directions. Housing, I feel like every time I'm talking, housing is something that has been a stalwart throughout the challenges of the pandemic and continues to be strong. Housing starts in March, we're up 19.4%. However, what we just saw this week, housing starts were down month over month in April by 9.5%. I'm going to equate the challenges to housing starts actually some supply chain disruptions. We're seeing the impacts of some of the supply chain issues, as well as the cost of lumber and other supplies like copper are definitely impacting the housing market right now. But everything related to housing, especially with price increases, are related specifically to supply. In Southern California, an average home year over year is up 28.6%, with an average home is around $750,000. But the issue is the fact that supply is down 53% on a year over year basis. And what we're seeing is inventory is about 1.6 months, whereas a year ago, the inventory was around 3.4 months. So the housing story continues to be the lack of supply definitely impacting prices. And with the low interest rate environment, that is definitely supporting it, and kind of some of the outputs that we saw from the pandemic. Individuals looking to move out of some more urban areas into suburban areas and larger homes if they're working from home. Manufacturing, these numbers, even though the Institute of Supply Purchasing Manager Index dropped in April from March, is still in that area that is expanding. What we've actually seen, industrial production as well, tipped up. A lot of this is related to continuing weak in U.S. dollar. It's been very supportive for the manufacturing sector, and we continue into 2021. GDP, as I already alluded to, we're very familiar with the decline we saw in 2020. What's interesting is the constant revisions we're seeing for expectations for 2021. Right now, with consensus for full year GDP coming in around 6.3%. What we saw is GDP in Q1 grow about 6.4%, again, with the reopening, with the vaccine distributions, and as well as with that fiscal support. But I do want to point to you that big number for 321, that column in the upper left-hand corner, you can see it. It's the consumer. You, me, going out, going to restaurants, visiting Disneyland, going on vacation, definitely has an impact on our GDP as we continue for this growth trajectory. And finally, yields. I mentioned this already, that what we saw in the first quarter of this year with the growth expectations, with the inflation expectations, we saw a significant rise in the yield curve, where the yield curve has steepened significantly on the longer end of the curve. First off, as you can see in the chart in the upper left-hand corner, you'll notice that we've got charting the 10-year notes in solid green, 5-year Treasury notes in gray, and the 2-year notes in that magenta color. You'll notice the 5-year notes, 10-year notes have that uptick in the first quarter of the year, was where 2-year notes are staying flat. And then you can see that representative of the steepening of the yield curve in that chart in the upper right-hand corner when you compare where the April yields are in solid green, where they were in January in 2021. Steeping significantly, and the steepness is specifically related to inflation expectations, to economic growth expectations in 2021, while the short end of the curve continues to get anchored. What is this important for? Is because when interest rates start going up, a fixed income portfolio, a bond portfolio, has an inverse relationship to the movement of interest rates. So if interest rates go up, the value of a fixed income portfolio goes down. Interest rates go down, the value of a fixed income portfolio goes up. And you'll see that from the total return for the city's portfolio in the first quarter, and I'll talk about that in a second. But as we continue through 2021, the expectations for growth continue with the massive support from the federal government, with the successful vaccine distribution. There will definitely be hiccups that we're expecting to see throughout the summer. Some of the economic data might not be meeting expectations, especially relative and related to employment and labor. But as the Fed has indicated today, we're going to start seeing a little bit more clarity once we get to September, and especially as we start to see reopening of the schools. Any questions about any of those economic things that I covered before I get into the city's portfolio? Perfect. So let's review the city's portfolio. So the objectives, in order to provide safety and preservation of capital, providing sufficient liquidity for cash needs, as well as a commensurate rate of return. We've got our performance objective against a benchmark, a 1 to 3 year benchmark, ICE BAML Agency Treasury benchmark, and with the strategy to make sure that it is in line with the investment policy for the city, as well as with California government code. So this is the most important page, I believe, in the entire presentation, showing that the city of Mission Viejo's portfolio is in compliance not only with California code, but with the investment policy. And here we can look at some of the characteristics for the portfolio. I'm sorry, was there a question? Okay. So if we look at the city's investment portfolio, I'm going to focus on that middle column as of 3/31. You can see the average maturity is just over 2 years. We have a duration of 1.87, which is definitely in line with the duration of the benchmark. We have a purchase yield of 1% and an average market yield of 0.31%, with an average credit quality of AA+ and a total market value of $20,474,000. Now, a couple of things. The value of the portfolio increased from a $5 million deposit that was made back in January. And from that deposit, we went forth and allocated the assets into purchases. That's why the purchase yield dropped comparatively to where the purchase yield was as of December 31. Again, in a sense, purchasing new securities that were at a lower yield comparatively to the matured portfolios in the portfolio. However, if we went out today, or as of March 31st, and went out and purchased all the securities in the city's portfolio on March 31st, the yield would have gotten was 0.31%. So what that means is we have embedded gains built into the portfolio, especially from the interest rate movements that we saw in 2020. And as we move forward, we can take a look at the composition for the sector distribution. I'm going to focus on the donut on the left. As you can see here, the Treasury allocation of 37.6%, agency allocation just under 27%, a corporate allocation of 18%, as well as exposure in asset-backed securities and CMOs, with a little bit of exposure to commercial paper and supranationals. with a little bit in that money market fund that's still being allocated. I do want to point out, though, some of the differences that we see in the allocations between December 31st and March 31st. You'll notice that there's a significant drop in agencies, as well as a significant increase in treasuries. That's because what we have seen over the past, since the beginning of the year and even towards the end of 2020, agency paper has become very expensive. It is actually trading through treasuries. Generally, you would expect to see agencies to have a spread above treasuries. So in a sense, a comparable age, if you're buying a 3-year treasury note or a 3-year agency, you would expect to get a spread of around 5 to 10 basis points on an agency note above a comparable treasury. That is not happening anymore. Some agencies are actually trading at yields lower than treasuries and more expensive because of, one, Fannie and Freddie have declined all of their issuance schedules this year. So there has been no issuance. The last time we saw issuance from any agency debt or agency issuer was back in mid-December of 2020. And with that lack of supply, they've become more expensive. And then therefore, it's not an opportunity to be able to add those to the portfolio, and as well as to be able to sit there and possibly sell those to allocate into other sectors, and specifically treasuries right now, supranational debt, as well as asset-backed securities as we move forward into the summer are definitely sectors that we will continue to look at, and I expect to see an increase as we move through the summer in those allocations. And we're also very tactical for the corporate allocations as well.
Chris?
Yes.
Chris, it's Ed Rosenblatt. Quick question. So you moved quite a bit out of agencies and moved more into U.S. Treasuries. I'm just wondering why corporates also decreased slightly. Isn't the yield generally higher on corporates for a given duration relative to treasuries? You might be able to squeeze out some more yield on corporates. Why weren't corporates added more to the portfolio?
Because, and that's a great question. The reason is because the spread level on corporates has compressed so much right now that it's actually at the tightest it's been since the early 2000s. So in a sense, that additional compensation that you would receive for a corporate note above a treasury is at levels that are extremely tight. So generally, we would want to make sure that you're getting plus 30 or plus 40 on a corporate note above a treasury. But right now, there are some corporate notes that are trading plus 15 and plus 20. So in a sense, they're extremely expensive due to the increased demand that's out there. And therefore, due to that fact, we're very tactical about what corporates we're actually allocating for the city. So and I'll talk about some recent purchases. We actually participated in a purchase for the city for Amazon. Amazon issued some debt earlier in May. We were able to participate in that. And where we're actually looking at is very, very high rated corporates, as well as we're looking for opportunities in the financial services sector, because those are ones that are very healthy right now and have attractive spreads compared to the other corporates. We don't just want to go in and purchase corporates at very, very tight levels, because in a sense, you're not getting additionally compensated for that additional risk of adding them to the portfolio. And so that's why we're looking at treasuries, because of the fact that that additional compensation need to get back to a more normalized spread level. And that's where we'll actually start to see corporates providing that. Supranationals are providing some of that spread level right now, which is a little bit more attractive. But the market is very, there's a lot of money in the system right now. And there's high demand and high chase for yield, which is driving these spreads to historical lows.
Okay, thank you very much.
Welcome. So with that, the next page will actually show you the issuer list that we have here with regards to, as you can see, the majority in U.S. Treasuries or U.S.-backed agencies, as well as with all corporate allocations we're very comfortable with. However, I will note Oracle Corp. Oracle Corp is a position that we actually exited out in April. Oracle was downgraded by Moody's and Fitch. They did still maintain their A rating by S&P, so it's still in compliance with the investment policy. But we had made the decision to exit out of Oracle due to those downgrades, and we're actually sold the position at a gain for the city. But we continue to monitor all the positions and do not have any concerns with any of the positions in the city's portfolio at this time. Moving forward, you can actually see the quality distribution As you can see here, this is rated by S&P, where 64.4% is in AA. Also 7.3% showing not rated. That means they are either rated by Moody's or Fitch. If this was by Moody's or Fitch, you would actually see the AAA ratings significantly higher. That's because S&P has the U.S. government rated at AA. The duration distribution. So as you can see here, we're comparing where we're allocating portions of the funds from March 31st comparatively to December 31st. And what I would like to reference here is as that yield curve steepened throughout the quarter, we increased our exposure in that 3-year area, that belly of the curve, but also in that 4 to 5-year range. And with new purchases that have been made recently, what we've actually seen is we're making purchases in and around that 4 to 5-year range, maintain the duration for the portfolio, but to take advantage of those steepening yield curves, in a sense, those higher yields at the longer end of the curve. And that's where, and if we do see corporate allocations, we're generally going to be trying to allocate those corporates in and around that 4 and 5-year mark. And here's the investment performance. So as you can see, for as of ending March 31st, you can see for the first 3 months of the year, the city's portfolio came in at a minus 0.22%, compared to the benchmark at minus 0.05%. And again, that's related to the city still received income, but also due to the depreciation of the bonds due to the movement of interest rates over the quarter. However, over the past year, what we saw is the city's portfolio came in at 1.49%, comparatively to the benchmark at 0.2%. For 2 years, 2.77%, the benchmark at 2.79%, and since inception, 3.16%, where the benchmark is at 3.2%. And here you can see the portfolio characteristics for the city's allocation to LAIF as of March 31st at $17.5 million. I will say, as of today, the yield on LAIF is 31 basis points. Here it does reference it as 33. They have been maintaining they've been doing a very good job of maintaining their yield in a sense as they've increased their weighted average maturity. But we do expect the LAIF yield to start approaching in the 20 basis point range as we get into the beginning of the summer.
Chris, I have a question.
Yes.
I'm new on the committee. My question is, what's the longest average maturity that Mission Viejo's portfolio has had? I don't know how long your tenure has been as portfolio management, but do you have any idea? Our maximum is 5 by charter. Is that correct?
So in a sense, by the investment policy, you're not allowed to purchase securities greater than 5 years, and that is in line with California code. Generally, from my understanding, maintaining a benchmark following a 1 to 3 year Treasury agency benchmark, which would put you in line with having a duration in around 1.8 to 2 years, and then the weighted average maturity would probably be comparable to that, between 2 to 2.5 years. So I wouldn't expect it historically to have been, especially with our tenure back in 2018, to anything approaching above 2.5 years.
Okay, thank you.
Yep. And moving forward, as we can see here for the for LAIF, as well as the small portion of the local government investment pool, and then the consolidated information. So this is for the entire portfolio. As you can see, the average maturity when you're combining LAIF as well as the active management strategy of 1.1 years, the duration of 1.01, purchase yield of 0.69%, the average market yield of 0.32%, average credit quality AA+, and a total market value of $38 million. And as you can see, here's the consolidated sector distribution with the majority in LAIF at 43.2%, as well as a little bit of an increase in the corporate application with treasuries at 20% as the larger secondary.
I have a question for you.
Yes.
Our investment policy specifies a maximum investment in each product type by percentage. How do you monitor that?
So, and that's actually a great question. So I'm actually going to jump back to the compliance page. So we do an annual review of the investment policy. And then when we review the investment policy, as you can see here, each category has specific requirements. So you can see here, I think what I'll do is I'll point to medium-term corporate notes as a good example. As you can see here, the maximum allocation of corporate notes is 30%. The maximum issuer allocation is 5%, and the maximum maturity is 5 years. We have an internal compliance system that is completely separate from our portfolio management system that inputs all of the parameters of the investment policy to what we call our Bloomberg claim system. So it's something that we utilize through Bloomberg. What that does is it places compliance limitations on the portfolio managers so that we're not able to quote unquote violate any of the parameters of the investment policy. So just to give you an example, let's say we decided to participate in the Amazon new issuance in May. And if for some reason that would have placed the allocation of corporate allocation above 30% for the city's portfolio, our system would have blocked that, okay, and would have not allowed it. So we have a multi-pronged system, not only of reviewing the policy, putting that data in our compliance system, and then our separate entity, our compliance team actually takes it and is separately from our portfolio management team to make sure that the portfolio stays in compliance with the parameters of the policy.
Good answer. Now another question. In our policy on page 9, it shows a maximum of 20% for government, federally insured and government bonds. And on this page that you're showing these graphs, it shows the Treasury at 20.2%. Is that beyond the limit?
So yeah, so the Treasury allocation, and are you talking about specifically on the investment policy?
Yes.
Okay, I would need to give me a second to look at that. So in a sense, Treasury allocation, we don't have any limitations. If you give me 1 second, I'm going to stop sharing, and if I could bring up the investment policy for a second, if you don't mind. So I apologize. So I can actually be on the same page as you. Okay. Okay. And investment policy. I know I just redlined this 2021, and I'm bringing up the recommendations. I'm just waiting this to open up. And you said on page 9?
Yes. The investment policy.
Okay, I'm on page 9 of the investment policy, and you're referencing
3A, 4B.
Okay.
Page 9 under 4B.
Page 9. And it's and what subtitle is under?
4.
Okay, federally insured time deposits. Okay. No more than 20%.
More than 20%.
Okay, and those are for CDs. So, and then you're referencing, and I'm going to share my screen again, if you don't mind, so I can bring this up. Okay, and then you're referencing on which showing that to be higher. And I know were you looking at this page?
Yeah.
Okay, so what that's federally insured time deposits are actually related to FDIC insured deposits into a bank, like a CD or like a savings account at a bank that is actually federally insured, like the FDIC insurance. That is not taken in consideration treasuries, agencies, or other federally backed notes. So
Okay.
it's a different type of investment.
Great. So your computer system's working.
Yes.
Thank you.
You're welcome. So moving forward, so this is the consolidated performance information and the consolidated sector distribution. And as you can see here are the portfolio holdings with the asset-backed agencies, corporates, treasuries. And as I mentioned before, for the total portfolio, as you can see, that's with LAIF, but as the total portfolio gain built into the portfolio, of 166,000. And then as well as the transactions that we can see for the portfolio. So any questions about any of the other aspects of the portfolio or any of the transactions that we were executed on during the quarter?
I'll ask another question, Ed Rosenblatt. Chris, you mentioned earlier on that many firms expect inflation to be transitory and that there are base effects because inflation was so low 12 months ago that it's higher in comparison now. And that later in the year, towards the fall and into next year, inflation might drop down back to normal and GDP might drop down more to a normal level. So first of all, first question is, in that case, do you expect the yield curve to flatten as a result? Because the bond market may not be expecting high inflation any longer later in the year. At some point, the yield curve might flatten again. The 10-year, the 5-year treasuries might go down in yield. And therefore, the prices of these bonds may rise at some point. Do you agree with that view? And if you do, are you positioning the portfolio at some point to take advantage of rising bond prices?
So I would answer that in two ways. One, when we look at the yield curve at the short end of the curve is managed by the Fed. And the Fed has indicated, so in a sense, when we look at that, yields 2 years and under are definitely right now anchored by Fed and Fed policy. Fed has already indicated that they are not expecting to raise the federal funds rate until 2023. At that point, we could see definitely the beginning of a flattening of a curve, like we had seen with the last time the Fed continued to raise rates going into 2018, 2019. For inflation expectations, and the longer the curve is driven by inflation expectations as well as growth. There is expectations that the near-term high inflation metrics that we're seeing, the Fed believes they're going to be transitory. There is some concern about whether or not they are going to be transitory in some areas, as well as where we could constantly see the yield curve moving within the next 6 months or towards the end of the year. There is an expectation that due to continued economic growth in the United States, with the increased vaccine distributions, with the reopening, and with going back to the schools reopening in September, combined with global reopening, in a sense, the rest of the world has kind of lagged behind vaccine distribution, and we've seen some challenges with the pandemic in areas that have not been as aggressive as the United States, the UK, and Israel with the distribution of the vaccine. And so therefore, we could see some support from global increased growth, which then could continue to steepen the yield curve, okay? We are actually expecting the yield curve to continue to steepen throughout the year. We might see some months where it does flatten a little bit. In April, the yield curve did flatten a little bit compared to March, and you can see that by this little dip right here, saw in yields. But we're not expecting it to flatten significantly because it's not going to be in conjunction with the Fed actually raising rates in the short end of the curve. So therefore, we're still going to have this steepening of the yield curve, which is going to give us an opportunity to take advantage and, in a sense, ride bonds and ride those rates down the yield curve, in a sense, that carry trade that we're expecting. So I think we're going to see some volatility, and there is an expectation that the yield, that inflation, these high inflation numbers are going to be transitory. But going back to the Fed's goal of maintaining inflation to be above 2% over an economic cycle, that is expected to continue to occur into 2022. And where we're actually expecting to see, where I think it's going to have the biggest impact on the yield curve as well, is the Fed's indication about when they're going to start tapering their asset purchases. Because what that's going to do, it's going to signal to the markets that the Fed is seeing improving economic conditions. Okay, in the sense the economy is improving, we're going to continue to see growth. We're probably not going to see growth again at 6.3 because of the massive federal stimulus. But that infrastructure package that's expected to come in September is also going to be a supporter for continued growth as well. So we're not expecting it to change, and we're actually positioning the portfolios right now to maintain our duration of our benchmark, and in a sense have a barbell portfolio where we're able to take advantage of those yields on the higher end of the curve, and then have some shorter maturities that we can either sell or reinvest. We continue to see that steepening, and so that's the positioning of what we're setting up the portfolio for now.
Okay, let me just ask you one other thing related to this, so I understand. You know, the latest CPI came out at 4.2, I believe it was,
Yep.
For April. You're expecting inflation to be more in the 2 to 2.5 range in the future, maybe in 2022. So the higher inflation numbers above 4% are expected to be transitory. So with inflation running at 2 to 2.5% next year, wouldn't that have the effect of flattening the yield curve at around the 5 to 10 year range?
You would think, but the problem is that the impact that the Fed is having because of the purchases and because of Fed policy. And I think where we'll see more of a flattening of the curve in the sense, you know, when we look at lowering rates, that's going to be an increase in demand. But with the issuance that we've seen and with the expectations, yeah, I would agree with you that you would think that, you know, if we get back into a more normalized inflation environment, but the problem is we have not really experienced inflation within the past 20 years. It has been sub 2% of the Fed's goal. And one of the bigger indicators that is a big proponent, and I believe is one of the bigger proponents for sustained inflation, is wage inflation. Okay. We're starting to see some indications that wage inflation, especially for bottom earners, for the bottom 25%, is starting to come into effect, which will continue to support that inflation number to be higher, a little bit higher than expected, and above that 2% level in the near future. But if wage inflation starts to get a little bit uncurtailed and starts to increase significantly, there is an expectation that employers will be able to curtail that with technological advances. So we won't see a huge run up in inflation, but even getting to that 2% level and above 2% level would actually be a significant increase from what we've seen over the past 20 years because they haven't been able to reach that goal of 2%. And that's what they're looking for. So could see a little bit of a flattening of the curve, especially on the longer end, in and around possibly that relationship between 5 and 10s. But I think until the Fed starts to ease up their policy a little bit, we won't see that dynamic, the difference between 2 and 10s, I think within the least next 6 to 12 months.
Okay, thank you, Chris.
Any other questions? Thank you.
Great. Thanks so much, Chris. Andrea, do you want to comment at all on the investment policy review or?
Sure, I could present a staff report. Okay, so the investment policies for the city, housing authority, and community development financing authority are adopted annually by the city council after it's been reviewed by the Investment Advisory Commission. Today, staff is requesting input regarding items that the commission would like us to study between now and August for possible inclusion in next year's investment policies. Staff recommends one update to the city's investment policy. The California Government Code was amended earlier this year to permit investments in securities issued by or backed by the United States government that could result in zero or negative interest accrual if held to maturity. This provision will expire on January 1st, 2026. Staff recommends updating the city investment policy to reflect this change. There are no recommendations for revisions to the Housing Authority and CDFA's current investment policies. Recommendations and amendments to the investment policy will be presented at the next IAC meeting in August. So we're just asking for input from the commissioners today.
Does anybody have any input on the investment policy?
I don't have any input.
No, not Rich. Okay. It looks like there's no input as of today. Andrea, thank you.
Okay. All right. So then the investment policies will be presented to you in August for approval for recommendation to the City Council.
Okay, great. Okay. So can we have a motion to receive the report from Chandler and file it?
I motion to receive the report from Chandler.
Second? I'll second it. Can every commissioner state your name and your vote, please?
Edward Rosenblatt, aye.
Liz Pagliarini, aye.
Rich Steinhoff, yes.
Art Levine, aye.
Okay, great. That motion passed unanimously.
Will we still have a chance for input at the next meeting on that?
I'm sorry?
There will be recommendations made at our next meeting. Will we still have a chance for input, or is it as is?
No, that's, well, we're asking for input tonight, but if you're not prepared for that, you can always email me just before the August meeting. That way you can include your recommendations or your comments in the August.
I just interpreted it as input would be at the next meeting when recommendations are made, but that's okay.
If I just could offer, if you do have any questions about the change to code SB 998, I'm very fluent and familiar with it. So I can run down a summation of what occurred if you'd like.
No, it's okay.
Okay.
Okay. I know Cheryl is not here. Andrea, do you have comments you're making on her behalf at all?
I don't have any.
Okay, great. Do any commissioners have any comments at this time?
No comments.
Okay, it looks like we are adjourning this meeting.
Hold on, I'm sorry, I do have one.
Okay.
I don't know who can answer it, but I just have a question regarding the golf course where it talks about revenues and expenditures on the financial report. Is the golf course expected to be running break even or at a profit or at a loss? Just curious.
You know what, I'll follow up with you regarding that. I'll get you an answer and I'll email you, Arthur.
Okay, thank you.
Arthur, we're in a unique situation because Cheryl isn't on the call. She's on vacation or and she usually would be able to answer.
Oh, that's fine. Whenever these are just questions for my own edification. Because one is I play the course. Two is a lot of people ask about it, and I would love to know whether it's expected running at a break even or not.
I think when we've had this discussion before in prior years or when they acquired the golf course, they absolutely. The hope was that it would run at a profit, at least break even, but then at a profit. So, you know, that was their analysis when they were making the determination whether to acquire it or not. And
Yeah, right
it's my
now, it's
recollection.
sustaining itself, and the general fund hasn't had to subsidize the golf course.
Okay. All right. Are there any other comments? Good. Okay, then we will adjourn this meeting at 5:27. Thanks, everybody.
Thank you.
Bye.
Bye-bye, everybody. Take care.
Bye, everyone.
Bye.